Okay, so we're going to start the last topic on corporation tax, and it is intergroup payments. So if you go to your notes, and it's we already finished on losses last week, corporation tax losses. After that, there's a page with intergroup payments on it. So if you've got a group of companies together, how they can actually share out their losses.
What page is that? 10?
It's page 10. Page 10 of the last section. Yeah, if you go at the very back, it's actually 3 or 4 pages into the very back. 3 pages into the very back. That's it there.
Tell me last week.
Yeah, back of page now. Is that page 10 there?
Right.
Yeah? So it's intergroup payment. So a member of a group is permitted to make certain payments to another member of a group without deducting tax in certain circumstances. To be eligible to make such payments tax-free, there must be a 51%, okay, there must be a 51% relation between the companies, where one company controls at least 51% of shares in the other company, directly, indirectly, or via a common parent. Interest and royalties may be paid gross without deduction of tax if a group relationship exists, and in similar relief applies to a consortia, but there must be a 75% relationship. Okay, so you have 51% for if you've got like a parent and 2 subsidiaries, but if you've got more than that, then you're going into a consortia, and you actually have a 75% relationship there. Members of a group may surrender current year trading losses, excess charge and income, excess management expenses, and case 5, excess capital allowances. Okay, so if you had company A, company B, and company C, and they're in a group and they have the 75% shareholding between them, then if company C has a 300,000 loss and company A and B have profits, company C can actually transfer out their losses and A and B can actually utilise them. And they can use their trading losses, their excess charge and income, their excess management expenses, and their case 5 excess capital allowances. I remember the excess case 5 capital allowances from last week. Just if you want to reference it back, it's back to page 4 of that same handout where we did the excess case 5 capital losses. And they're actually good, those excess case 5 capital losses. You can set against total profits in the same accounting period, set against total profits for the immediately preceding period of the same length, and carry forward against future case 5 income. And the thing is there, you can put it against your total profits. So like that's like taking your trading income, and like if you have case 3 or case 4, you can actually reduce that as well. So they're a good one to have, case 5 capital allowance, excess capital allowances. So the claim to relief then, 2 companies are members of a group. If 2 companies are members of a group, if one is the 75% subsidiary of the other, or both are 75% subsidiary of a third. A company is 75% subsidiary of another company where not less than 75% of the ordinary share capital is owned directly, indirectly by that company. Parent company must be entitled to 75% of the profits available for distribution to equity holders. The parent company must be entitled to 75% of assets available for distribution to equity holders on a winding up. Group relief is available to Irish companies, subject to certain conditions in respect of trading losses incurred by their non-Irish subsidiary companies that are resident in the EU member states and the EEA states. That's like other European Union affiliated countries. They're not actually in the EU, but they're in Europe. So like Switzerland or Luxembourg, I think would be another one that would be in there, in which Ireland has a double taxation treaty. So to claim the relief, you claim its deduction against total profits for the accounting period. Okay, so against your total profits is the important thing. Claim before reduction by any relief from subsequent accounting periods and after reduction by any other relief from tax. The surrendering company must consent in writing and notify the revenue. Claims must be made within 2 years, just in case they ask a time limit, it's within 2 years from the end of the surrendering company's accounting period in which the claim relates, and relief will be restricted if the tax return is delivered late. And there is provision for apportionment on a time basis of the surrendering company's losses and the claimant's company's profits where the accounting periods do not coincide. So say the loss happened in, say, September 13 year end, and your year end was December 13, then you can only take 9/12 of the loss, you can't actually take the full amount of the loss. I'm doing a good few questions now on this tonight, but just the important thing is to know is a 75% relationship must be there. And they just give us, in the exam questions you'll see, they give you ones to work out to see is a 75% relationship actually there. Just that extra handout I gave you out there, if you want to have a look at that. It's just a little handout I found that explains it using diagrams rather than just words. So you've got the top one here, you've got the holding parent company, subsidiary 1, subsidiary 2, and subsidiary 2, subsidiary 3 even. The parent company holds directly or indirectly 75% of the ordinary share capital. The company must be resident in the EU, and since 2012, group company now includes a company which has its shares traded on a recognised stock exchange. So if you look at example 10.1 there, which companies are in a group? So you've got A owning B, 100% of B and 100% of C. So A owns 100% of B, A owns 100% of C, A, B and C are all in a corporation tax group. Okay? They're all in a group together because there's 100% there. They're over the 75%. On the next one, you've got direct ownership. A owns 100% of B, B owns 100% of C. So then indirect ownership, A controls 100% of C limited via B. So, do you know what I mean? A owns B 100% and then B owns C, but it's kind of like through B, A also owns 100% of C. Okay, so A, B, C are all in a corporation tax group. Okay, and it's corporation tax group, and that's for losses we're looking at the moment, because when we're doing capital gains tax, there's going to be CGT groups we're going to have to be looking at. Okay, our next one, we've got A, B, C. A owns 100% of B, A owns 100% of C, B owns 50% of D, and C owns 50% of D. So direct ownership, A owns 100% of B, so that's grand. A owns 100% of C, B owns 50% of D, C owns 50% of D. Indirect ownership, A controls 100% of D via B and C because it's A owns 100% of B and owns 50% of D then through them, and then it owns 100% of C, and if C owns 50% of D, overall A actually still owns 100% of A indirectly through B and C. Does that make sense?
Yeah.
Yeah? Okay. Okay, our next one, we've got A, B, C and D again. A owns 100% of B, A owns 100% of C, A owns 30% of D, and C owns 50% of D. You've got an indirect ownership then, because A controls 50% of D via C, the total control is 80%, because taking the 30% they own and 50% they own from C. So that's bringing us up into our 75% range. So they can actually transfer their losses to each other. And then we have another one. We've got direct ownership, A owning 100% of B, A owning 100% of C, but then C owns 50% of D. So A controls 50% of D via C. The total control is only 50%. So D, A, B and C are all members of our corporation tax group, but D is not a member of that corporation tax group. Okay? Is that alright?
So if these made a loss?
If they made a loss, they can't put it back up into A, B or C. And they can't put it back up to C either, because there's not 51% or a 75%.
So 55% then
if there was 51, you could pass it up to C, yeah, but because it's not 51%.
And if C made a loss, they can't carry it forward to D if they want to.
Sorry?
If C.
Yeah, they can't. No.
So
it has to
C,
be complete ownership, like, doesn't it?
Yeah, yeah.
if it was 51% that C owned D, they could use the loss.
C and D only. But they can't, because they haven't got 75%. Yeah.
So if it was 51%, the C and D would be able to share.
Would be able to share their profit, their losses, but they still couldn't pass it over to A and B.
So it's more than 2 members, so that there has to be 75%.
75%, yeah.
I was just seeing the.
A consortia, I always think a consortia as being over more than 2.
More than 2 groups.
Yeah, more than 2. Yeah? Okay, the next, just don't mind about the next one there, and we've read on that already. But if you go to the bottom slide, you can only surrender current year trading losses. That's an important thing there, that you can only surrender current year trading losses to another group company. And the recipient can only use losses to reduce their CT liability, current year deduction against trading income, and current year credit against other income on a value basis. So you're not going back. Do you know what I mean? You can't go back. It's only the current year you're actually looking. So if you say you have A, B, and C in their group, C has 300,000 of a loss, and they use up they transfer out 100,000 to A, 100,000 to B, so they have 100,000 left. Well, they can't go back. So A and B can't go back and do a prior year. The 100,000 is actually carried forward into C's books, and C keeps that for his making a profit. He can't transfer it out unless, like, if he went to next year and he makes a loss then again, then he can transfer it over. But that 100,000 loss is ring-fenced to be put against their profit in the following year.
So it's when you do in the year,
yeah.
in excess,
Yeah. For that specific company, yeah. Yeah. So otherwise there'd be losses going here, there, and everywhere. Yeah. Okay, and the rest of them is only just some more examples, but I think instead of reading through all that, I'll do questions there with them shortly. And then at the end of that, there's actually just an article I got online that actually just goes through all of it and just shows that you can transfer your losses up, down, sideways. If you go to page 3 of that article, so there's the losses can be transferred up, they can be transferred down, they can transfer it up again, and they can be transferred sideways. Okay? There's not just like, you know, up, you think maybe. And just maybe if you did want to read through it, it's just a little article to...
So it's just 75% loss can be put anywhere?
Yeah.
If one company out of 5 is making a loss and it's all 75% or more, they can
spread it out away to the rest of them. Yeah. And we'll be doing questions. There's a lot, they actually ask this a lot on the paper for 10 marks. The group reliefs. I just have one more thing to go through before we do questions. And it doesn't even do questions for the rest of the night. The term, I know I just read a small bit about the terminal loss, but there on page 12, it's just about the terminal loss again, going back to the other slides. A terminal loss is a trading loss incurred within 12 months before the data cessation and may be used to reduce income of the same trade arising in the 3 years immediately preceding those 12 months. So it's when you're ceasing and you make a loss, you can actually go back 3 years and actually bring that loss back for 3 years. Relief under section 397 is given only respective losses which cannot be otherwise relieved. The losses to be set against income of a later period in priority to an earlier period is not to displace relief already given or capable of being given for losses carried forward from earlier periods. So all you have to worry about is that you have a terminal loss, you can go back 3 years, but what you do in your first year, say you finished in December of 14, well, if you have other income, you should put your loss against that first and then carry back your terminal loss. So get rid of your current corporation gas liability first. Then if the financial accounting period is trading is less than 12 months, the terminal loss is the aggregate of the loss, if any, at the period and the loss, if any, sustained in the part of penultimate accounting period beginning 12 months before the date of cessation. What that means is, if you ceased, you did a 9-month accounting period when you ceased, then when you're going back, you can only relieve 9 months of the trading income from the year before. Okay, you can't relieve the full 12 months.
So you have to try and storm out the year to get full benefit?
Yeah, if it was 12 months, but if there's 9 months, or if you did a 6-month accounting period, you can only bring it back 6 months, if you only save 6/12 of the trading from the year before. That's what all that means inside there, really.
So unless you're making catastrophic loss altogether, get the year.
Yeah, get to the end of the year and use the full 12 months.
Or at least like stop trading but keep the company going until the end of the year.
And then cease it then at that. Yeah. Okay, other than that, that's only all about terminal losses. There's nothing else there. The best way to do it is actually do a question. Okay, and I have a question actually in this pack, the same pack we have here. Okay, I want to do the question on page 5 first of that handout. It's just see where they just do the case 5 capital allowances there, where they've got a good lot of capital allowances they can actually use.
Beta, is it?
Beta, yeah, has the following income and allowances. Or let me get a bit bigger. Let me get a bit better? Bigger?
Yeah.
Is that better, yeah? Okay, so it is beta. Okay, I'm just going to put across the years 10, 11 and 12. Okay, 31st of March 10. 31st of March 11. 31st of March 12. Of corporation tax computations. Okay, so we've got Schedule D. Case 1. Okay, for 10 is 18,700. 15,600, 17,290. Okay, just don't bring the case 5 out, just bring the case 1 at the moment. I just put out there just so I remember what to do. Okay, and the reason we're doing this is look at see where the last column there, the case 5 capital allowances. Okay, so we have case 5 income in March 2010 of 5,800. And we've got case 5 capital allowances of 2,300. So automatically we're going to take the 5,800 and take the 2,300 off of that. Okay, the case 5 capital allowances. Okay, so I'll just do it inside here. Okay, so that is minus 2,300, which brings our rental income down to 3,500. Okay, because you allocate your case 5 capital allowances against your case 5 income first. That's alright, isn't that one? Yeah? Our next year, we've got March 2011, we've got case 5 loss of 10,400, and we've got case 5 capital allowances of 24,730. So that 10,400 loss, a case 5 loss is ring fenced, you can only put it against case 5, but case 5 capital allowances can be set against total profits. Okay, if you look over on page 4 again, set against total profits of the same accounting period, set against total profits for the immediately preceding period of the same length, and carry forward against future case 5 income. Okay, so we can actually take that 24,730 and set it against our 15,600, and then we can opt to actually take it back and put it against this, or bring it forward and put it against our 15,850. So you must see which is actually the best option to actually do with it from a tax planning point of view. So first we'll do it here. Okay, we take our, bring up to see what our loss is. Okay, so just do a little loss memo over the side here now. Okay, and we've got a case 5. Okay, it's case 5 loss memo, and it is the 31st, the 3rd 11, and that is 10,400. Okay, and that case 5 loss is ring fenced. Okay, we can only take that against case 5 income. Whereas our case 5 capital allowances, which is what? 24,730. We can do that 24,730 and set it against our total profits inside in March 11. And remember, our total profits is our total income plus our chargeable gains to give us our total profits. So for March 11, I have a total income of 15,600. So I'm going to utilise then that loss. So the excess, case 5, $15,600. Okay, current year against total profits. Okay, which will leave us with 24,730 minus 15,600. It's a bit, like, it seems a lot, doesn't it, that they actually allow you to put all that against your total profits. That brings us down to 0, isn't it? Income for that year. So we'll have no corporation tax liability. So for every different type of income you have, so if you're the trading loss, and you're a case 3 loss, and you've got a case 5 loss, and a case 5 capital allowance loss, set up a little loss memo for each of them, just so you can keep track of where they're going. Is that okay for that one? Yeah? So my case 5 now, this 9,130 that I actually have, I can decide now to set against total profits for the immediately preceding period of the same length. So I can do this 9,130 now, and I can go back to March 10 and put that 9,130 against it. So we go to a prior year against AGEINST total profits again. What's our total profits here? It is 18,700 plus 35. And how much weight they can actually put against it? 9,130, isn't it? Bringing my income down to 13,070 and getting rid of all this loss here. If I go back up there, have I added it up?
To the left as well.
Left this way?
Yeah.
The other way.
No, fine, yeah.
10,400 loss that has to be used in the current year, is it?
No,
or no, that's using this
that
trade
means
rather than case 5 or
case 5 only, yeah. So we're going to carry that forward into the next year, which is what, March 11?
we can't bring it back.
You can bring that back.
So it's either this year or future
Yeah.
years.
And you do it inside here then, this 9,130, you get rid of your case 5 income first. So take 3,500, that's gone. And you're actually being taxed and then at the 12.5% rate.
Can I just do the last memo there then?
Yeah. Okay, so I just finish it there. So minus 9,130 and we're down to 0. On that one, so we will have 30, because we got rid now of all our case 5, all we have is 13,070 at 12.5%. Okay, so I got rid of 3,500. Okay, and then the rest went against 18,000, so it's 13,070 or 12.5%. So get rid of your 25% income first and leave the 12.5% one to be the taxable one. Inside we're going to the 12 here. Yeah? Okay, inside the 12 now we have case 1 of 17,290. And we've got case 5 of 15,850. So against that now we're going to push the 2,100 capital allowances. I'm going to carry forward our 10,400 loss from the year before. So we'll have minus 2,100.
You take the loss first and then the capital allowance.
Yeah, it doesn't make it, but you should normally take do the capital allowances first and then take the loss off then. And then minus 10,400. Okay, which will bring us down to case 5 of minus case 5 of 3,350 when we actually started off at 15,850. Okay, and just to show you, the 10,400 here is only going against our case 5. That 10,400 can't go against our total profits because it's a case 5. Yeah, case 5. us total income of 17,290 plus 3,350. No chargeable gain, so our total profits is 20,640. And that's taxed at, what's our case 1? 17,290 at 12.5%. And in the balance, 3,350 at 25%. So that is 2,161,838, which is €2,999. Is that alright? Yeah? And just there, I said you can't carry back a case 5 loss, but you can carry back a case 5 loss, but you know, you go against your case 5 income. So the reason I took back the case 5 capital allowance is because it can go against total profits. Whereas if it was a case 5 loss, it could only go against your case 5 income.
So if you know excess allowances there, you can bring your loss back.
Yeah, against your case 5. Yeah, but you couldn't put against the top case 1 figure at all. And that's only allowed in a company for self-employed or pay-by workers that are rental income. They can't carry back a case 5 loss. It's just a separate rule for companies. I don't know why. It's just
capital allowances.
no, they can't either. No, and they're actually ring fenced inside in a sole trader as only against case 5. You can't utilise them against other income.
Just a matter of interest there, case 5 is generally rental income, like, isn't it?
Yeah, all like
How would loss arise from rental income?
It's like, do you know what I mean, if the property wasn't being rented and you had a lot of expenses, then or else you were rented for half a year and your expenses were high like that, yeah. Okay, so that's just our case 5. Capital allowances, how we can utilise them against our total profits, and our case 5 loss only against our case 5 income. So if you go to page 6, it's not a last one, but this is our terminal loss. And just in this one, there's actually everything is thrown into it. There's a case 3 loss, there's a case 5 loss, there is a terminal loss, and there is a case 5 capital allowance loss. Just to make it do a bit more interesting, like.
How do you mean capital allowance loss? It's just capital allowance.
Yeah, it's the bottom one there, case 5 capital allowance loss. The one, or excess case 5, do you know what I mean? That 10,000 excess case 5 there now, you see it in here in December 11. We put that against our 5,000 case 5 income, and with 5,000 left over, we can actually put against our total profits. Okay? Yeah?
Yeah.
Okay, so let's look at a new one here now. That was called data. I have no thing on this, just page 6. And just to bring all those losses together. And then when we start doing the exam questions, you see the group losses. Okay, and you see the terminal loss. Our terminal loss is the one on the 30th of September 2012. Okay, and it's in 9 months. So we can only carry that back 9 months into the year before. Okay, because it's only a 9-month year.
So you can only cover
9/12 of it. Yeah. Yeah, that's all. is 20,000, 21,500, 10,000. That's my terminal loss in there. Case 3. So the loss there, we've got 2,500, 4,000, 10,000. And just leave little space, little lines in between them there, just so we can put our things through in them. Case 5. 4,000, we have a loss of 1,500, 5,000, 5,000. Okay, and just to put your trade charges up here next to your case 1. Okay, trade charge off of your trading income and non-trade charge off of your non-trade income. Okay, to pay my trade charges, 2009 and 2010. And none in 11 or 12. And when you set up the loss memo now for each of the things we have losses in. So we'll have a loss memo for our case 3, for our case 5, for our terminal loss, our loss in our September 12. And see with the 30th September 12, our loss is 30,000. Okay, so our normal rules will apply first. Current year against trading income, prior year against trading income, current year on a value basis, prior year on a value basis, and then anything you've left over back 3 years after that. So technically you're actually going back 4 years because you're using the prior year, your normal rules, and you're going back 3 years after that again. Okay?
Oh, so you go from 12, you go prior year to 11?
Yeah.
And
then
10, 9 and 8?
Yeah, you can go back 3 years again then. Yeah. Okay, so just set up my first one here, my loss memo for my case 1. And that is 30,000. Okay, then I've got my case 3 loss. loss in here.
How much space do you leave now between all the
I actually put the last number maybe on the next page just so everything won't be actually squashed up. I actually leave with 1, 2, 3, 4. We have 4 transactions. I was just doing it up there to make sure I was okay. 4 transactions for the case 1 loss. For the case 3 loss, we have 1, 2, 3 transactions.
Sure, it's more.
3 much smaller.
Okay, so our case 3 loss is how much? €11,000. Okay, and the thing with our case 3 loss, a case 3 loss can only be set against case 3 income. Okay, so we'll be taking our case 3 loss and allocating it out across our 31st of December 10 and our 31st of December 11 and our 30th of December 12. We're going to take the case 3 loss and put that in first. Okay, so case 3 against case 3. So if nothing for December, for December 9, we've got 2,500 there inside December 10, so we're actually going to be wiping that out. Okay, bring it down to 0. Make note of that there, but where did we put it? We had case 3 loss against year ended 31st of December 10, and that is minus 2,500. We've year ended December 11, 4,000. And we've got period end, is that 30th of September?
Can you put it against the full amount?
Yeah, against the full amount, yeah. And you're saying, where would you have a case 3 loss coming from? Joe, case 3 covers foreign income, so if you have a loss on a foreign property or your foreign trading income or any loss, that's where a case 3 loss would be coming from. So that's minus €1,000. So that leaves us with 3,500. And we actually can't utilise that anywhere else because there's nowhere else to actually put it. Okay, because we've put it against all our other cases.
That's it, so just go to dead.
Just gone. And the reason I put it against, I put it against this one here last year before I did my other loss, because that saved me €1,000 worth of terminal loss that can actually be brought back. Yeah? Okay, I've put in my trade charges, haven't I? So just my trade charges off this. So I'll show what my income is here now at the moment. And not for 12. Okay, just take a little trade charges off of it. Okay, and remember your trade charges against your trade income. If there were non-trade charges, they'd be going down under our total income section. Okay, so I have a case 5 loss now, see there, in December 10 of €1,500. Yeah? Okay, so that 1,500 case 5 is ring-fenced against case 5. Okay, so what I'm going to do is actually bring that back and put it against December 2009. Okay, because you see I have 10,000 worth of excess case 5 capital allowances I can actually use in the next year. So that €1,500 going to be brought back into 2009. So just want to do a little last memo for our case 5, just so when you go back over it later, you can actually see it. Okay, so the last memo, case 5 is €1,500. I'm going to put that against period ended 30th of December 2009. So it's down to 0. Okay, and see the December 2009 is a 9-month year as well. But that doesn't affect us bringing losses back. It's only if December 10 had been a 9-month period, then it would affect us taking back losses in our trades. Like, but the 9 months.
The year the loss occurred.
Yeah, yeah. It's not when you're actually bringing back year, you're bringing them back here.
But the trade 3 loss, it doesn't matter.
No, trade 3 doesn't make a difference. So that leaves us with case 5, capital allowance of €10,000 inside the year ended December 11 and 2,000 inside the 30th September 12. Just do another last memo now for that. That's case 5, capital allowances. And that is €10,000.
Where are you going to know that?
Yeah, sorry. We're going to put that now. I'm going to bring that 10,000. I'm going to put 5,000 against my case 5 first in that year. Where is it? Here. Where's my 10,000 gone? Here, my 5,000. So minus 5,000 there. In that particular year. December 2011. So there it is, 5,000 case 5 income.
Oh, sorry.
Yeah.
You went to 2011. Case
Yeah, going to
yeah,
11, the case
sorry.
5.
But do we take that 1,500 off the 4 first, or the first from 2009?
Oh yeah, take it off there and put a line there. Minus. Somebody else thought that was my phone ringing.
That was mine.
Oh, was it?
Yeah, sorry.
I was wondering, was someone ringing me? Emergency. Okay, so that's our 1,500 gone in there. I forgot to actually, I did the last memo, but I actually forgot to actually come back and actually put it in. So now I'm bringing 5,000 here, capital allowances off my 5,000 income here. So that actually only leaves me with a 5,000 worth of loss then, isn't it? Okay, because you know, that's the current year, so take my 5 off my 5 and actually leaves me with a 5,000 worth of loss.
Did you put the year? Do you know your loss numbers there? Should you put like that was for me 2011 or something?
Well, if you want to make it easier for yourself to know where things are going,
It's just
you can, yeah. Okay, so what am I do with that 5,000 now? That 5,000 actually go against total profits.
2.5 first.
Sorry?
Total profits.
You can go against total profits that year, or I can go back against total profits of the previous year. Just look at it there now. So we're on 11, isn't it? Yeah, we're in 11. So we have 10,000 worth of case 1. We have no case 3. Our case 5 is gone as well. So I actually won't need to put that 5,000 in there, which I won't, because I will have my loss from here coming back to actually shelter all of that.
Probably not going to only use 9 months worth of that.
Yeah, to go back.
Go back.
Yeah, so if you do 9 months back first,
Yeah.
and that takes, I think it's 7,500,
Yeah.
and you have 2,500 left,
Yeah.
so you can have 2,500 in to shelter inside there.
Yeah.
I know it's, but like, do you mean, at the stage right now, you could actually face a question like that with all those
Well, you can do
losses.
7.5 off the 10,000 now with the loss in the next following year.
Yeah, and we'll have 2.5 in case one left. And we can use 2.5 out of that 5,000 lots we've left.
Yeah.
And then we build the shelter. Oh, we build because we have a prior year to come back as well. We'll do that. We'll do our, what we do here, we'll do our case 1 loss first now. Go back up to our case 1 loss, which is 30,000. So just your steps for that are current year, section 396A. And actually nothing for that because we have no other trading income. Prior year, section 396A. There was for the year there for the, and it's in 9 months. Okay, so it will be, go back and look at what our profit is, 10,000 euro. So we can only shelter 10,000 euro by 9/12, which is 7,500. So we go back in here, our loss we can take off is 7,500. Section 396A per year. Bringing it down to 2,500. But if you can actually put it under here if you want, do you know what I mean? By just putting it down, just make it easier.
What's that then?
That's the loss here from our 9-month loss. We can go back.
That's not a trade charge, that's a separate.
That's separate, yeah.
No,
Another, yeah, it's if you want to put a separate line in years. That's section 396A. It's how to utilise it. It's all about tax planning.
Yep.
In this, you're not supposed to tax plan, but it's how to utilise your losses in the best way. To actually, like, usually try to bring your corporate tax down to 12.5% instead of the 25% one.
Do not carry over 396A prior year to the following year's backlog by 2010, say.
I did, yeah, I brought back the 7.5 in here.
Yeah,
Next one is it?
to the next year back again. You can have me back there again.
No, but that's where we use our terminal last now when we're doing our terminal. Whenever we've left over out of the 30,000, we've 7.5 used,
Yeah.
and whatever we have left over, we carry back then against our other trading income. So inside here now, what I have no case, as I September 12 now, I have no trading income. I got rid of my case 3 loss, or profit for the case 3 loss. I have 5,000 euro now worth of case 5, haven't I?
Mm-hmm.
And I actually have another case 5 capital allowance there, so you have 2,000 euro, which I can actually utilise. In that particular year.
Yeah, 2000.
Yeah, 2,000, that's from here. The actual year itself.
Oh, yeah.
Which leaves me with 3,000 euro worth of case 5, doesn't it? I can do with that, I can actually take, let's see which one you can actually work best.
Do you take 9/12 to that now as well, or can you just take whatever?
No, it's the same year.
It's the same years, no, so it's right.
Yeah, but you know there's 5 grand left over from the year before.
No, it's only when it's coming forward it's grand, because the year before was a full.
So you can take it away.
Yeah, you must just look here now and see. We were wiping that out, with that wiped out. Yeah, so we'll just take the 3,000 out of here. So that is our case 5 capital allowance last minute memo. So that is going to period end 30th and the 9th 12 minus 3,000 euro. So I actually have €2,000 left.
What did you do there now? You took the case 5 from 2012, which is 5,000. Took the 2,000 off, so there's 3,000 there.
Yeah, so it was 5,000 worth of case 5, but you got the 2,000 capital allowances, and then taking there's 5,000 coming forward from the year before worth of case 5 capital allowances. So I'm taking 3 of that off it now.
Are you not better off using your 30,000 loss against that because you still have enough?
Because if you use up that there, you see you're actually down to nothing here.
Yeah.
You can't. I can't bring 2,000 back. I can't bring my 5,000 back because 3,000 is going to be wiped out here. My terminal loss, and I'm going to wipe out some of that as well. So I think we'll look and see now. We'll go
you can't wipe out the 2,500 then that's up there. That's left.
There's 2 left.
There's 2 left.
There's 2.5 in 2011 though, in case 1.
Oh yes, it's out here. We can't do anything with that. No, we can't wipe that out.
Okay, now use the
we can actually use 2.5 of that from this 2,000.
That's what I'm saying.
Oh yes. If I get the 3 out of here,
you have 2.5 left.
I have 2.5 left. So I'm better off taking 2.5 off of the other one first and do a current year write-off on a value basis. Yeah. Wait a bit there. We'll go back again. So if you go back here and wipe out that 2,500 worth of income we have here with our case 5 capital allowances. Against total profits. That's 2,500 there.
And that's the 5.
Where's that from?
That was
That's
from 2011.
2011. So when I had my prior year adjustment, I write off 7,500 of it. So I had 2,500 worth of income left here. I got rid of my case 3. I got rid of my case 5, hadn't I?
Yeah.
So I can actually bring back.
Are we reversing the previous one?
Yeah, we're getting rid of that 3,000 now.
We're using current year capital
Yeah.
allowances against
Don't take it off.
case 1.
Don't take it off at the moment. So we're using 2,500 there against year ended the 31st of December 11. Because it's more tax efficient, isn't it?
Yeah.
Now we have 2,500 left. And we've used that 2,500 against our
5,000.
for our current year one.
Are you allowed to do that? You don't have to do it in your current year first.
No.
No, you can do it.
That is current year.
We are actually taking current year for that 10,000.
The 2.5 capital allowances is against current year.
Is against current year. What I'm dealing with is that 10,000 here. The case 5 capital allowance, the 10,000. So I used 5.
Yeah.
Okay. Then I went and did my prior year adjustment, which I had 2,500 left. So I'm taking that 2,500 now worth of case 5 losses, case 5 capital allowance losses against that 2.5. So I'm wiping out my tax liability there.
And you still have 2.5.
And I still have 2.5 left. So we're going to put that 2.5 in here now, which means I have only €500 left inside here now.
Okay. Yep.
So that is period end. 30. Minus 2,500. So my case 5 capital allowance loss is actually gone now as well, isn't it? Yeah?
What you've left then is 500, is it?
I've left 500 inside in 2000 and September 2012, and I can get rid of that with a value basis current year. It's more thinky about where to put them than actually putting them somewhere. So I'll just make sure now September 12, I have no case 1, I have no case 3, my case 5 is down to €500, isn't it? So that's taxed at 25%. So So €500 by 25% is €125. And I'm going to wipe that out now by doing a section 396B current year on the value basis. Okay, so up to my case 1 now. So current year. So I have €125 worth of corporation tax divided by 0.125. Which gives me €1,000. So I'm down to 21,500. Just make sure I'm right there now. I've taken my last was 30,000. I used 7,500 inside in December 2011. Now I'm going to get rid of my tax liability for September 12 on a value basis. I need €1,000 to that. So I'm down to 21,500. Yeah? Is that what you're having? Have you 21,500? So when I go back in here, I have minus 125, or we do €1,000 by 12.5%, 125. So we've no tax liability now in September 12. We've no tax liability in, what's our year before? 2011.
So play back to the last one.
Yeah, so I can go back now to 10, and this is a terminal loss. So, no, because it's terminal now. The prior year thing only applies for the 9 months. Now, whatever loss you've left over, you can go back to your 2010 and wipe the loss out of it, wipe the profit out of there. And the thing is, it can only go against your trading income, so it can't go against other income. The terminal loss only against trading income. So I'm going in here now again. So this 21,500, and this is called a terminal loss. Okay, so I'm going to go into year ended 31st of 12/10, and that is 20,000.
We'll ask her to remember.
Sorry? So I'm actually left with nothing inside there, should I not? Yeah, my 20,000, okay, this is a terminal loss now.
Can I see the new memo there?
Which one?
The last memo you did there.
Yeah.
Flying ahead.
Just that easy when writing
There's nothing now in 2010.
Sorry?
2010 is down to 0 now.
2010 is down to 0 as well now. I think we've a small bit left now in 2009.
There's 19.
Yeah, and we've only €1,500 to go against it, isn't it?
Yeah. It's case 5 as well.
Oh, you'll be thinking and writing, you say.
So you've done it already. You've put all written out, okay?
Yeah, and I actually just make sure I put down here that the 2.5 should go against that. Ideally use against 25% passive income first, and then against your 12.5% one. Because when you get a question this, it's more like figuring out where is the proper list you can utilise your losses the most. So this €1,500 now we've left, we go against 9 months, period end, the 31st of 12/09. Period end, yeah. 31st of December 09. minus 1500, bringing me down to 17,500. See, like if in a real world, do you mean this would have happened like you're going 1, 2, 3, you're in your 4th year, so like all these returns would actually have already gone in.
But you can claim it back, can you?
Yeah, yeah. So inside 9 now we have 17,500 case 1, and we have 2,500 case 5. So it'll be 17,500 by 12.5% and 2,500 by 25%. So that is 2813? Yeah? So that's all the liability we have, isn't it? And the important thing to determine, like if you had, say like if you had 100,000 were terminal loss, you could always still put it against the
trade.
Yeah, you can put it against your other income. It's only against the trade.
You only hit for case 5 in 2009, no matter what, there's no way to work that out.
No, there's no way we can get rid of that. So the only loss, I think, if I go by my thing, the only loss we couldn't have utilised was the 3,500. Am I right? For case
3.
Case 3. That 3,500?
Yeah.
Yeah. That's the only thing we couldn't use. We used up everything else.
So you'll be claiming back all your tax.
Then back on the tax, yeah. We're like going to business, so.
Can we go back to the last member?
The last memo, yeah. Which one do you want?
Terminal loss.
Terminal loss here. So if you can do that question for losses, you've no bother in losses. Because actually it's every whole loss. Like a case 4, I can't see where you'd have a case 4 loss. Or case 4 is your deposit interest.
Foreign rent.
Foreign rent would be case 3.
Was it?
Yeah, case 3 is foreign.
What's under?
Case 4 is your deposit interest.
Yeah.
Or income not shown anywhere else. Or maintenance payments. Or covenants. So like how you're going to have a lot tonight, those kind of things. So I think we've nearly every loss inside there. And so like the hardest part is actually figuring out where to best utilise them. And so when you're at the stage, that's all about, that's like tax planning. You'll do more than that for Christmas where you're doing tax planning for people. It's like, yeah, it's like for tax planning, it's like, say someone who's going to make me a will, and what's the best options for actually, where to move around all the money to. Yeah.
Is there like a step-by-step for this?
Well, it's really looking at the whole, the overall, and working them out. Yeah.
I suppose it's that.
Starting with that.
6 steps.
Yeah, those steps, yeah. And then looking to see to utilise the 25% losses against the 25% income as much as you can.
You start 2009 and then work your way up.
Yeah.
You start in your first year.
Yeah.
The earliest year.
And work your way up. And then use this 30,000 for this year and go back 1 year and then go back 3 years for the terminal loss after that.
The value base, you only use that after you've worked out the taxes that's payable.
Yeah, after you've worked the tax, yeah.
If you've worked out 25% tax on something, you use value base then to knock it back.
Yeah, that's it.
Is that a guaranteed question for 10 marks, pretty much?
No, the group ones more, they seem to do, but they put in these ones as well. So
that question might come up like this.
It might, yeah. A portion of it might come up.
The whole test.
I'm going to look at the, let me see now, the exam papers I gave you out, August 2012. I might have that out a couple of weeks ago.
Full paper, is it?
Sorry?
Full paper.
No, it's this one, it's called, it's got a little diagram in the middle of it.
Sure.
Sandy, isn't it? Okay, thanks.
And this is all the August 2012 exam paper. So we're going to be doing the first part of it. Calculate the corporate requirements there. Calculate the corporation tax payable by each company for the year ending December 11. And second part is outline all tax implications for the group on the sale of Crafts Limited. We're worried about the first part for now. We'll do the rest of it when we're doing capital gains tax. Okay, so the first part A there we're doing. And it's the August 2012 question 1. So you're looking at, you're the tax advisor to Mark Stones, who along with his wife Mary own the holding company ABC Limited and a number of subsidiaries. The group structure is as follows. So you've got Mark and Mary owning 100% of ABC, 90% by Mark, 10% by Mary. ABC then owns 95% of toys and owns 76% of buttons. Okay, so you've got ABC owning 95% of toys, 76% of buttons. So ABC is in a group in this with toys and buttons. And then buttons owns 78% of crafts. Okay? So buttons and crafts are actually in a group together. But if you multiply 76% by 78%, okay, so 76% multiplied by 78%, we get 59%. And that's not our 75% for A to have an ownership inside craft. Do you know what I mean? Indirect ownership. If you look at A, true buttons owning craft, if you multiply 76 by 78, you get 59%. So true buttons, craft owns 59% of craft. Did I say that right?
ABC, yeah.
Yeah. True buttons, ABC owns 59% of craft. Does that make sense? Yeah? So we have...
You should just relabel them ABC and D.
Okay, so we've put in here gold. Okay, so we've got our ABC.
So buttons can use the...
Buttons
can use it alright?
buttons will be able to use crafts losses, but if craft losses can't be brought up to toys or ABC Limited. Okay, so the only one, if ABC had losses, toys and buttons could use them. If toys had losses, AB and ABC Limited could use them. But buttons and crafts, they're together. ABC doesn't own enough percentage to actually give ABC doesn't own enough craft to get their losses. And all the others can share. If you look over the page, what I'm getting at is because craft, I should look at that first. Craft actually have the losses. So toys, buttons and crafts. Okay, so the only one who can actually avail of crafts losses will be buttons. Okay, so toys actually will be taxed as normal, and craft will be able to utilise his losses, like we do in our ordinary losses, the 3968, 3968, 3968, 3966B, with buttons. Okay, so you can put it against 150,000 and you can put it against the 10,000. So if you want to put a note in there when we come back to that question again, we're going to put a note on the top of it. Okay, ABC, toys, buttons and craft. Okay, ABC, toys, buttons and crafts are all part of a capital gains tax group for when we're doing that question later on.
ABC, toys.
Toys, buttons and craft.
But crafts isn't part of the...
Well, it just says here, there's capital gain tax group, there's different rules for capital gain tax group. Because it's 59% and a 51% rule, do you know what I mean? 51% rule comes into capital gains tax. Are part of the capital gains tax group. Then you've got ABC, toys and buttons are part of a loss group. Yeah, ABC, toys and buttons are part of a loss group. And then buttons and crafts are a loss group as well. So you have 2 loss groups within the one little figure there. And if you look what you were asked to do, calculate corporation tax payable by each company for the year ended December 11. So even though we won't be doing toys normally, or you're doing your corporation tax computation, we still have to do it because they asked for all the calculations. Okay, so if I do toys first, it's actually the easier one. So toys limited. And just that explanation you've given there, you know, you'll actually have to give that to show you know what the loss groups are. Okay? So toys limited, corporation tax computation. 21st December 11.
You've got to be careful with the taxes as well. Second taxes or taxes.
Okay, so our Schedule D case 1 is 200,000 and our Schedule D case 5 is 10,000. So I just do total income 210,000, chargeable gain 0, total profits 210,000.
Chargeable gain is always added on.
Yeah, to give total profits. So just bring in all your schedules, case 1, 2, 3, 4, 5 in there, and then you're giving your total income and your chargeable gain. So we've got 200,000 at 12.5% and the 10,000 at 25%. Is that alright? Yeah? Okay, then we have Butlins Limited. Just put in their income. But did I use the wrong? Didn't I? The wrong case 5? Didn't I? Sorry, my fault.
The testing.
120 extra.
Yeah. It just should be 30,000. Sorry, I had 10,000 in. I was taking the rent from Buttons.
Should you do your 2 costs and should you do
Yeah, we do across, yeah, just to make it easy. We can show the one, the losses across. Okay, just leave a little space in between to put in our loss. this is crafts. Okay, so crafts, we've no case 1 and we've got 10,000 worth of case 5.
I'm bringing my computer next week.
It's easier when your sheet is limited.
New page.
Yeah, I just put the two of them together just so we can see the losses going over and back.
Well, buttons and crafts, is it?
Yeah, buttons and crafts, yeah. So 150,000 for buttons, case 1, and 10,000 case 5, and then craft has got no case 1, we've got the loss of 300,000, isn't it? And it's got income of 10. So remember now we're dealing with current year here now, okay? Because our loss is in 11, so we're dealing with current year, we want to have a prior year to actually look at. So if we make a little loss memo now, okay, so loss memo. Okay, so we have crafts. Okay, and 31st of December 11, and it is 300,000. Okay, 300,000 of our last memo. Okay, so our first job, okay, for this 300,000, you actually utilise it inside in craft first, okay? So we're dealing with a group, you utilise it inside in the company you have first. So he's got a loss of 300,000, so we're going to put it against this 10,000, but because it's a case 5, we have to do it on a value basis. So you'll be taking our total income of 10,000, giving us total profits of 10,000. So that 10,000 at 25% is